It's time for the Phil Ferguson Show.
This is Phil Ferguson, and of course, you are listening to the cleverly titled The Phil Ferguson Show. This is show number 415. Wow, absolutely amazing. I can't hardly believe I've been doing it this long. I think it's close to 6 or 7 years. I'll have to look it up. Maybe I'll have the correct answer for the next show. Oh, by the way, for the next show, I've already got an interview recorded with Tony Davis, and he's going to talk about his book on religion. And I know that you're going to enjoy that. And the other topic for the next show, again, next show is non-transparent ETFs. Going to blow your mind. I guess it won't blow your mind because you hear all the time about the crazy, stupid stuff that the industry, the investment industry in the United States is allowed to peddle to people. Anyway, fun stuff in this show. I'm going to have a little rant here on Trump in a minute, but it's going to be short. Then I'm going to talk about yield inversion. And then there's 3 additional segments. One is about ETFs and how they work and how they're marketing and what NAV, net asset value, is. A little segment, just kind of from a consumer advocacy thing about eyeglasses and how to buy eyeglasses and my recent experience on eyeglasses. And talking about kind of consumer advocacy kind of stuff, big update, I guess a new rant on Bitcoin and some of the problems that it has and some problems that it will have. A few things that I hadn't thought of or talked about before, but then some stuff that I've talked about before and I'm bracing for the hate mail. And of course, if you love Bitcoin, if you truly, deeply, profoundly love Bitcoin, and you want to tell me that I'm wrong, that's cool. But have a point. The generic emails that I historically get, something like, everything you said is wrong. Don't waste my time. Don't do it. So the quick news on Trump, he got a hole-in-one. Isn't that exciting? All the things going on in the world. He still loves Putin, to the best of my knowledge, thinks he's a goddamn genius for easily taking over Ukraine. Of course, a tragic, epic attempt at genocide and massive loss of life from the Ukrainian people. And our thoughts and hearts go out to them. And I hope this can be resolved soon and we can help them recover and rebuild their cities, their town, their houses, their economy, their culture. And that the penalty for Putin and his minions is significant and severe and long-lasting. I want it to be one of those things that any other strong man who has an army sees that there is a potential downside for doing stuff like that. I don't know if we have the moral fiber to see it out, but, I like the dream. The other thing that has popped right up right before this conversation. Oh, I forgot. Yes, Trump got a hole-in-one, bragged about it, and of course at the bottom said that he won't say who won the match because he doesn't like to brag. Are you fucking kidding me? Anyway, I don't want to spend any more time on that idiot. I want to talk about the yield curve. More importantly, yield inversion. And so really short, it's just going to be a quickie thing. We've done longer segments on this in the past, but generally speaking, if you were going to lend somebody money, the longer you lend them money, the larger of an interest rate you want to get on the money that you lend. If I'm lending somebody money overnight, I get it back tomorrow. You can lend it at a very low rate. And I don't mean just because it's one day, but it's an annual rate divided down to 1 day, but it's a lower interest rate. 1 month or 1 year is a little higher. 2 years, 5 years is a little higher. 10 years, 20 years is higher, because if the interest rates on shorter money were higher, what you could do is lend somebody money for a year and then lend it to them again for a year and then lend it to them again for a year. And each one of the 5 years, you could get a higher interest rate than the total 5 year. You have more control and flexibility over the money that you're lending, because you could deny lending the second or third year. So the default orientation is that the longer the bond, the longer the loan, the higher the interest rate. This works with car loans. This works with CDs at the bank. The bank will pay you more if you promise to leave your money and not touch it for a longer period of time. That's the normal part. It's the normal way the world works. Well, so that creates what's called a yield curve. On an XY axis, you can put the length of the loan and what the interest rate going up vertically, and you'll get this curve to the right. Every once in a while, we get to a position where we get what's called an inverted yield curve. You can use 1 month versus 1 year. You can use 5 years versus 30 years. I think the normally accepted things to look at are 2 and 10. And so you compare the interest rates of a 2-year bond to the 10-year bonds. And if the 2-year bonds are paying more money, a higher yield than the 10-year bonds, that's generally seen as quite a negative indicator. And it also means that the people who are lending money, and of course the people who are borrowing the money, are willing to pay more for money that they have to pay back in 2 years than what they would pay or get for money that they lend in 10 years. Again, the implication is that I need a bigger return in the next 2 years or so, because the risk of you paying it back is higher than if I just give you 10 years. And there have been studies that show that when this happens, and I think the other day it happened for a day, maybe it happened during a day, and maybe it'll happen again, and maybe it will be a sustained yield curve inversion, not just a flat curve. In the past, many times when this has happened, a recession has followed, and I'm looking, oh, here it is. I'm looking at an article on CNN, but you can find it anywhere. It's something about 10 or 11 or 15 times that this has predicted a recession. Not predicted, preceded a recession. There, of course, was one time where it happened where there wasn't a recession. So you think to yourself, okay, if it's 10 to 1, it's a pretty good indicator. Yeah, maybe. Now, one of the things that you need to know, and one of the things I definitely talked about last time I reviewed this, is there's an inverted yield curve, and then there's a high correlation that there then is a recession. What you're not told is when is that recession. That recession can be a few months away or over 2 years away. And a couple of times when the recession hit after 2 years, the market had 1.5, or even 2 full years of wonderful growth. So if the yield inversion hits and you say, okay, that's my marker, I'm going to sell everything. I'm not recommending that, just to be clear. We're just talking out loud. If you did that in a couple of these cases, you missed 10, 20, 30, 40% market appreciation. And then when the recession hit and the market fell 10, 20, 30%, you might have missed the drop, but you missed all of the increase in advance of the drop. You're actually money behind if you had just done nothing. So even if it correctly predicts a recession, and we can talk about that in a minute, but even if it does, you don't know when to get out. Even if it did tell you when to get out, you got to know when to get back in. And not only do you have to get out and get in the right time, if you're in a taxable account, you may create for yourself a tax bill that's sufficiently large enough that it overrides any potential value that you benefited from timing the market. This is why a lot of people, me included, will say, don't time the market. Just have the correct portfolio. As one of my listeners helped me explain, I used to say, when someone says, what are you going to do to protect me from a down market? And I would say, I'm not going to do a fucking thing. This listener educated me, gave me a much better phrase. I've already done it. I've already done what needs to be done to protect you from a down market. The portfolio design, the Polaris plan, is created in such a way that if you're younger, you're 100% in stocks because you're going to benefit the most from long-term return. If you're closer to retirement or if you're in retirement, the cushion is there. It's already in place to protect you. So I guess, if someone asks, what are you going to do different, or what are you going to do additionally, or what are you going to do new to protect me from the theoretical falling market? I'm not going to do anything additional. I'm not going to do anything new. The plan already works. The reason it's designed the way it's designed is to do the very thing that you want it to do. It's already in place. The goal, of course, is to get a reasonably large part of the stock appreciation over the long run while providing sufficiently large enough short-term protection in case the market goes down in the short run. It's always a balancing act. There's no one right way to do it. I like my way, maybe just because it's my way, but here we have it. So again, like I said, this is CNN, what's it called? Do bond investors know something others don't? Okay, stupid title. But it talks about yield and yield inversion. Even if there is a yield inversion, even if there is a correlation with how frequently it comes before a recession, even if there is a recession, you have to have all the timing right on top of all of that. It's just not going to happen. Okay, maybe it does happen. But I'm playing the odds. The odds that we don't know when the correct time to sell is, the odds are we don't know when the correct time to buy back in is. So keep moving forward. If you are worried about your portfolio going down because you're going to retire soon, double check. Make sure you have sufficient cushion. If you have questions about that, we can talk. If you have questions about that and you're not a client, we can still talk. Send me an email, Phil@Polaris Financial Planning. Do not send any confidential documents or statements. And of course, a quick reminder about all the other things that I talk about. Unfortunately, because of the Department of Labor's rulings, I am no longer able, I'm choosing not to, review, analyze, or give opinions or consultations on ERISA plans, which include 401ks, 403bs, TSP if you work for the government or any other agency that uses that, those kinds of things. Maybe in the future that'll change. But so don't get all in a tizzy about the theoretical recession that's coming. Now, another reason to think that this is possibly different, one of the reasons that the 10-year interest rates are as low as they are is because the Fed, the Federal Reserve, has been involved with and is still involved with aggressive quantitative easing. So in short, what the Federal Reserve does is it goes out and buys 10-year bonds that are issued by the U.S. government. And so it's the government, one branch of the government, buying bonds created by another branch of the government. This is the kind of stuff that sets fiat currency haters through the roof. They think it's absolutely obscene and it allows the manipulation of the dollar and interest rates. Yes, it does. And I will say as a counter, that's actually the fucking purpose. All right. And so when the economy is soft or when there's a fear from a pandemic like we had in 2020, making money easier to get, adding money into the system really helps prevent that recession from hitting and harming a lot of people. When that was done in 2020, it might have been the right amount of money, but it was done in such a way that it created a giant fucking massive boondoggle. And people ripped off the government and the taxpayers in billions and trillions of dollars. And very, very few people are ever going to be held responsible. The idea of just handing out money willy-nilly to companies that, even companies that had incorporated just days before, absolutely tragically obscene. And all of that happened under Trump and the Republicans, and they didn't give a fuck. They just handed the money out. One of the things I said at the time was that was going to happen, A. And B, even if the money goes out fraudulently, it's still getting into the economy. It's sad and tragically wrong, but it would still help the economy unless the money went to another country. And I've read some recent data that says as much as 30% of that money went overseas. It's just fucking gone. And even if we did figure out who got it, we can't get it back. It's gone. So that was a huge, colossal fuck up. Now, after Biden got in office and the Democrats were in charge, we did it a second round. I think it was less necessary, and maybe it was too big, especially in hindsight. The second go was too big, and it was done only marginally better. So both Republicans and Democrats can fuck that shit up. Other things to keep in mind is that we are at a time where clearly some people are suffering because they have to pay for gasoline or natural gas or propane to heat their house. And thankfully, spring is coming for a lot of the country. And that makes it very difficult for people during these times where there's inflation. But generally speaking, not always true, but generally speaking, inflation is a sign that the economy is too strong and there's too much money in the system. And that's one of the reasons that the Federal Reserve has increased the Fed funds rate, that is the overnight lending rate, between banks, because banks have to keep a certain percentage of their assets on hand, the deposits on hand. They cannot lend 100% out. If they don't have enough money on hand, each night they have to borrow money overnight to meet the criteria. Yeah, it sounds silly, and it is, but it actually works. And so as the Fed funds overnight lending rate goes up, it can become either more expensive or harder for a bank to meet the threshold. If the amount of money that's available to lend from one bank to another becomes more challenging, banks might call a few loans or make loans a little less available so that they can comply with the banking requirements. So it kind of puts a little bit of tightening on the money control. And you want to do that, if possible, slowly. But we've had some inflation numbers that annualized look like 5 or 6 or 7% inflation. Keep in mind when those numbers look that big, what they'll do is they'll take the number for a month and multiply it by 12, assuming that's going to be the rate for the next 11 months. And so when there is a report of 8% inflation, what happened was you had 0.75% inflation in 1 month times 12. That gets us to 8, doesn't it? 4, 8. No, it'd be 0.66, so it's even lower. So you have 0.66 times 12, which works out to 8, I think. I've got the math right. And so the inflation is not that high in that month. It's annualized. So they take that and multiply it by 12. So that number can bounce around. So be careful which numbers you're looking at. A lot of it is driven by energy prices. And now that China has talked about doing a little lockdown on a big part of the country, again, to avoid the spread of COVID, that means China is going to be doing less economic activity, less driving, less building, less sales, less production. And so the demand for oil can go away, or the demand for oil will decrease. There's also stories about more tankers are actually showing up at Russian ports and taking oil, and they're just turning off their transponders. And yes, that's bad in a way, but it's good in a way. But there's always this economic benefit. And so from what I've read, and again, I'm not there, I don't know, if the average price of a barrel of oil is $100, Russia's selling their oil for $30 to $40 off. Because when you pick up that oil, there's always the risk that you're not insured. There's always a risk that you can't get it off your ship and deliver it to somebody. So the people who are doing this kind of on the sly want a bigger margin to carry the oil because there's bigger risks that they're going to get stuck with the oil. But it does create a little bit of a pressure valve where more oil is delivered, so the price of oil doesn't spike too much. It does bring revenue in for Russia, which is one of the things we want to avoid, but they're getting a lot less revenue. So it has part of the effect and only part of the damage to other countries around the world as the global oil supply doesn't fall precipitously. if you really think that we should not be involved with this game of global oil supply, well, then we should figure out a way to not use fucking oil. One way, of course, electrification of cars. Solar panels on virtually every house with an unobstructed view of the sky, or on your property, or a couple percentage of farms, or stop putting water on the desert to grow corn in Arizona and replace it with solar panels. I mean, it's more efficient use of the land, more efficient use of energy. Figure out how to have better battery storage technology for the excess energy that's created during the day so it can be used at night. And or, one of my favorites, I hope it works out, what they call a gravity battery, where they have these giant assemblies of cranes that lift 5, 10, 15, 20-ton blocks up 20, 50, 100, 200 feet. And it takes a lot of energy to lift this block. And then when you need energy back out of the system, the crane comes and grabs that block and lowers it. And by lowering it, you recapture that energy and add it back to the grid. So there's all kinds of different ways we can do things. Or maybe we still need coal and natural gas and nuclear, but we need them at a lower base level overnight. And if we can use not 80% from coal, but 20% from coal, that's a big improvement. So any improvement. We also would need to find out or figure out or reliably use things that aren't plastic. Hemp-based products. I don't know. I got a little mouse here in my hand. Can the mouse be made out of something that's not oil-based? Shopping bags, some kind of fiber or fabric instead of plastic bags. Products from grocery stores that come in jars instead of plastic containers, like shampoo, and maybe you pay 10 cents or 25 cents or 50 cents, depending on the size of the jar, and you bring it back and you get your deposit back, like Coke bottles back in the 80s. That was the thing in the 80s. 70s, I know it was a thing. Some states still have that, but or possibly aluminum containers that can be recycled. They're a little bit more robust, but they last 4 years. So everything that you buy doesn't have to come in a plastic bottle, like a 24-pack of plastic water bottles. Oh my God. What? Just the water coming out of the ground, using clean drinking water in places where we already have clean drinking water, and then putting it in plastic bottles so that we can damage the environment. Just all that. So think about those kinds of things. But as far as a recession, I don't see one coming. We have record numbers of people changing jobs and getting pay raises. Those aren't typically signs of a recession, but I don't know. But if we get a recession, when does it start? If we do get a recession and we know even if we knew when it started, when does the market go down and when does the market go up? Because as far as investing, what I talk about, that's what you really are concerned about. So it's a complicated world. Just be aware that there's going to be talk about recession, and some places are going to try to tell you it's wonderful, and other places are going to tell you that the sky is falling. So if you hear only one opinion, be careful. You might be putting yourself in a bubble, and you might want to seek out an alternate news source of some kind. But like I said earlier on, I've got a lot of stuff for the show. This is going to be probably a 90-minute show. So strap in. We'll take a little break and get on with the actual show. This is an email-inspired little segment on ETFs. The gist of the question that I received from a listener was, I see company X advertising their ETF on TV, on radio, wherever. Why would they do that? Because if the shares are already created and they just trade on the marketplace, why would they advertise the ETF? What do they get out of it? And I thought, what a great question. So thank you very much for that question. And I did send them back an email, but once I had worked all that up, I thought, it's a segment already written, so I should do that. So a couple of things to start with is closed or open-ended mutual funds. Almost every mutual fund or ETF you've ever heard of is open-ended. That means that additional shares can be created or destroyed at will at any time, following regulations and legislation, laws, rules, all that stuff. The number of shares can change. Now, you're used to that with a mutual fund, because if you send $10,000 to a mutual fund company, the mutual fund company takes your money and the money from everyone else that sends it money. And once it gets enough extra cash on hand, it buys additional shares of the stocks that are in that mutual fund. Of course, it might sit on the cash for a couple of days or a couple of weeks or a couple of months and use it to buy one new stock that they're adding to the portfolio. But while they're sitting on that cash, you as the investor, on the day that you invest the cash or the next day at the latest, you get shares of that mutual fund. So the mutual fund just creates additional shares, and temporarily, in that specific case, they might have slightly more cash on hand, the $10,000 that you sent them, and they give you shares that are worth the $10,000 based on what is called the NAV, net asset value price, that is established after the close of each business day. So one of the good things or bad things, depending on how you look at it, mutual funds are evaluated, or they calculate the value, the net asset value of a mutual fund once a day after the market closes, after all the stocks finally settle up their prices for the end of the day, the close of business, the close of the markets. Then the mutual fund will come in and take all those numbers and say, how many shares do we have of everything? And of course, it's all done by high-speed computers very quickly. And poof, this is the net asset value, the NAV of this mutual fund, if every single stock sold at that price at the end of the business day. Poof, that's how much each share is worth, actual dollar for dollar. You can have closed end mutual funds where you buy shares and that fund does what it promised. And of course, it sells a certain number of shares and then it just keeps on doing what it's doing. No one can add money. Maybe it's difficult even to get money out because it's closed. There might be some rules of how to get out, but they're complicated and they're going to be slow and it's going to be hard to get your money. But the nice thing about a closed-end mutual fund might be that they have almost no expenses. They have almost no overhead, at least from their perspective. They still might have a really high expense ratio, but theoretically, the expense ratio could be lower because in a closed-end mutual fund, they don't have to deal with the money coming in and money going out. That's one of the problems banks have. They have a lot of money, but people want money to go in. They want money to come out. So it's a lot of transactional activity where you're having expenses, but you're not making any money as the business, as far as the business's perspective. There are closed-end funds, and they're available, and you can go look them up, but they're rare, quasi-rare, semi-rare. I don't know what's the ranking for that. They're few and far between, and you would have to go look for them, or you would have to have someone that wants to sell you one. If they're trying to sell you shares of a closed-end fund, that means the fund has not yet sold all the shares that are available to sell. Not necessarily bad, but why is this person recommending something that's going to be difficult for you to get your money in or out of, or particularly out of? Probably won't be that hard to get it in, but it'll be hard to get it out. Sometimes with a closed-end fund, you may have to wait quite a long time to get your money back. Again, it could theoretically be better, but I don't like it. I want to be able to get my money, all of it, if I go crazy, in a couple of days. But that's me. Depends on you. Now, an ETF, generally, like a mutual fund, is an open-end ETF. Now, you as the investor, when you want to go buy shares of an ETF, you go on the market and you buy shares of the ETF. There is still someone running the ETF. So the ETF is different from a mutual fund, a couple different reasons, but the biggest thing that you'll notice is the process in which you go about buying shares. With a mutual fund, you send money to the mutual fund company. They give you credit for owning X number of shares of the fund that you put the money into. In an ETF, generally, you go out to the marketplace, the NASDAQ, not the Dow, there's no ETFs in there, one of the trading platforms, and you put out a bid. You say, I'm willing to pay this price for a certain ETF, and someone is probably willing to sell you shares of that ETF. Some people really adore ETFs because you can trade them intraday. You can see what the value of your ETF is intraday. You can see the price that it trades for. Very important little point here. The price that an ETF trades for may not be, most likely will not be, the net asset value, the NAV. And you might say to yourself, how can that possibly be? Again, I'll oversimplify it. Let's say an ETF owns one stock, and that stock is $80 a share. Therefore, one would assume the ETF is approximately $80 a share, although it could be in a different ratio, but I'm trying to make this simple. So the ETF would normally trade for $80 a share. If someone says, no, I really want that ETF, I'm willing to pay $80.50. And someone else who owns it that just bought it for $80 says, hey, I'm willing to sell it to your dumbass for $80.50. Boom, a transaction is completed. The price of the ETF is based on the most previous transaction. When you watch the ticker that goes up along the bottom of the TV or on your computer, if you have one set up, that shows you the price of a stock. The price of the stock is determined by the most recent transaction. Someone bought it, someone sold it. Is that the right price? Who the fuck knows? Those two people thought so. One person thought it was a good idea to sell at that price. Another person thought it was a good idea to buy at that price. What's it really worth? Well, there's dozens, if not hundreds, of books written about that. But that's what that price along the bottom of the screen means. That's the most recent transaction. ETFs are the same way. If more people want to buy an ETF, its price may be higher than the combined value of all of the assets contained within the ETF. Often not by much, because if it gets too high, many people that own it will want to sell it. But if there's something weird or something psychological, there's a mood, there's a change in supply and demand caused by some other factor outside of how one values an asset, you can have a period of time where the asset will trade for a little bit more or a lot more or a little bit less or a lot less than what its NAV is. As an example, and I'm just doing this off the top of my head, I'm not looking at the numbers because I don't care enough to go check it, but there are Russian ETF funds, ETFs that you could buy. And some of them, as soon as Russia attacked Ukraine, in a couple of days, fell 90%. Well, you might ask yourself, how in the hell can you say that the price is down 90% because the Russian stock market has now not been open for like 2 fucking weeks? Nobody knows what the price or the value of those companies is. Will it be half when the market opens back up? Will it be 5% when the market opens back up? Who knows? But there was a dramatic number of people that wanted to run away from owning anything in Russia. I can't say I blame them. I would probably be in the same shoes. But so many people ran away and so few people bought that the price on the Russian ETFs collapsed without reference to any change in known value of the companies. One could assume the average Russian company is now worth less. I think that's safe to say. But is it 20, 50, 80%? Who knows? But the ETF fell 90%. And I happened to see recently an article that showed Russian ETF jumps 100% in 1 week or a couple of days or something like that because it fell from, let's say, $100 a share to $10 a share, a drop of 90%. And then a few days later, it went from $10 a share to $20 a share. Yes, it did go up 100% from $10 to $20. It used to be $100 a share. Now it's $20 a share. So it's still down 80% from a few weeks ago, but up 100% from a few days ago. That's the fun you can have with percentages. And it is bizarre, and we don't normally deal with it in our world, which is why compounding growth is so tricky to understand. We live in a plus and minus world. We don't live in a percentage world. We don't live in a compound interest world with geometric growth world, which is what happens to stock prices. But anyway, aside from that, so you can have an ETF that trades materially below or above the price. What can happen is that the company that manages or runs this ETF, who also, by the way, they do charge you an expense ratio. The case we were looking at was 0.2%. So it's a very high efficient, very low cost, not as low as some of the other ones and not as low as some Vanguard funds that go down to 0.05, 0.04, 0.03, where you get diminishing returns. The amount of money that you save going from 0.04 to 0.03 is about 0.01, right? It's a very small change. I mean, it's a favorable change, so take it, but don't kill yourself over it. In the ETF, what happens is when more people want to buy than is available, the price goes up and you think, okay, well, that's the market forces in place, and that's just how it works. So again, why would the company market these ETFs and try to get more people to buy them? To drive the price up? No, not really, but yeah, kinda. Because let's take another ETF. Let's say its correct net asset value price is $45, but it's currently trading for $47. Clearly, if the price is higher than the net asset value, the demand is stronger than the supply. The company that runs that ETF can go and just create more shares of the ETF by buying more shares of the companies that are in the ETF. So they buy more stocks, they create more ETF shares, they sell them on the market. So if everyone's paying 42, but the underlying value of the shares that they had to buy to create an additional share of the ETF is 40, they spend $40 to buy the shares and they sell them on the market for 42, right? That sounds pretty sexy, doesn't it? Well, that's one way an ETF fund can make money. I don't know that that's a very common or a big part of their business, but it's a part of the model. It's a part of the business. It's if it's only 5%, maybe it's 80%, I don't know. But they can make money that way through a classic arbitrage. They can buy something at one price over here, $40 for a basket of stocks, and sell it over here because the demand is high for $42 per share of the ETF. Well, why would you not do that if you're the company running it? So there is that. Of course, if you are making trades within the normal day-to-day operations of the ETF, you might have a part of your company that does the brokerage part, and they get paid for making the transactions. So not only do you get the expense ratio like a mutual fund company does, but you can pay yourself or a branch of your company a reasonable amount of money, whatever that means, for other operating expenses that aren't part of the expense ratio, because the expense ratio contains all items required by law to be listed within the expense ratio. It doesn't include any expenses or costs that aren't required by law to be in the expense ratio. There are other costs. It can be very hard to find out what they are. They'll probably relatively accurately revealed within the prospectus, which can be 100 pages or more that you're never going to read. But there they are. It's revealed. But so that's one reason why a company might market or advertise or promote the ETF, is that they can make more shares if the demand is higher than the price. They could also buy back shares if the market is soft. So again, if the net asset value of this ETF is $40, but it's trading for 38, the company that is creating and managing the shares might say, that's crazy. There's no reason for it to be 38 because it's really worth 40. So they can go on the market themselves and buy the shares for $38 and hold them until it returns back to the correct price, the net asset value price of all the underlying goods or stocks, and then sell them back for 40. Another thing that is interesting to know about ETFs, that you hear all the positive parts. Now, these interesting, quirky parts may or may not really be that big of a negative. I mean, I'm oversimplifying and overexpanding the value of these things, but they're there. So I'm just trying to help you understand it. Everything is way more complicated than you think it is, probably. But a company can create these additional shares and sell them for more than the net asset value. If the ETF shares sell marginally below the net asset value price, the company that creates the ETF can go on the market and buy them if they have the impression that they are actually worth the net asset value and can then at some point sell them for a higher price. Of course, the other super secret magical trick that is always just out of sight is the spread. And this applies most simply when you buy a stock. Often what happens is you often offer to buy it at, let's say, $65. Someone offers to sell it at $64. Again, the spreads usually are pennies in this modern age, but they still exist. A broker will often be in the middle of that transaction, and they will buy the shares that someone's willing to sell for 64 and then turn around and sell it to you who's willing to pay 65. So there's $1 per share in that case. Again, it's often pennies, but so the person selling the shares and the person buying the shares aren't always, sometimes they aren't always paying the exact same price. 100% of the money does not go from the buyer to the seller. There's a middleman. Sometimes it's great to be the middleman. The middleman almost always gets a cut. Before you freak out and say that that's not necessary, they do provide actual functions in the market. They often are called market makers, not money makers. They make money. Market makers, which sometimes will step in and prevent a stock from falling unexpectedly by picking up shares and increasing artificially in the short term the demand for a stock. And they can do the opposite when the stock goes up. They are holding additional shares just to facilitate them being the market maker that they can then sell when the price gets crazy high, and they can offset the sudden spike in demand. It keeps an extra layer of stability in the market. So sometimes they have expenses to be a market maker. Sometimes they make a bunch of money by being a market maker. But generally what they want is smoothly functioning, reliable markets where they can get pennies, sometimes a couple of pennies, sometimes 40 pennies, whatever. Many, many years ago, it would be, half a point, half a dollar, because they would trade stocks and, a half dollar, quarter dollar, eighth of a dollar. But that's always been there. That's always been an inherent part of the system so that they can do that. And of course, the person selling the ETF probably won't get that spread because that's what the brokerage and the exchange is doing. But that's a potentially added cost if you are an investor. So when someone tells me, Phil, I don't want to buy a mutual fund and pay $30 or $35 for the transaction, I'll pay nothing or $10 to buy an ETF. Keep in mind, of course, you might have to pay $10 to sell the ETF. If you're investing small amounts of money, that might be cool because the spread is small enough that it doesn't add a material amount to your trade. The interestingly ironic thing is that if you're trading tens of thousands or hundreds of thousands of dollars, if you have a $500,000, a $2 million portfolio, when you make a transaction, the unseen cost, the spread that you might be paying, can easily be more than the $30 or $35 you might have paid just to trade in the mutual fund instead of buying shares of the ETF. And of course, the more money in the ETF, the more the company that runs the ETF gets as a management fee, the more money they make if they have to issue shares or buy shares at a discount. So that's kind of the short answer, I guess. Wow, that was 20 minutes. I thought it'd be 5, but that's some information about how ETFs work, how mutual funds work. Almost every mutual fund or ETF that you have ever seen is an open-ended. And with reference to the ETF, the company that runs it and manages it and gets an expense ratio out of it and possibly transaction costs can also benefit by being able to buy shares at a discount under the NAV price and create new shares if the demand is high above NAV. So there's all kinds of ways for these guys to make money, which is why they do it. Anyway, I'm going to stop, collect myself, and we'll go on to something else.
I'm not worried about dying because I'm an atheist, right? Now, I know that this is a Christian country and I stand up for your right to be religious, but please know that you're wrong, right? Please know that you're living in a fantasy land and that after you die, nothing happens. Stop being a fucking child. I'm not scared of dying because I'm an atheist. I know I'll just rot in the ground, right? I won't even know I'm dead. Do you want to know why? Because I'll be fucking dead. Religious people worry because they believe in heaven. If there's a heaven, there has to be a hell. And everyone who's read that book knows that you've done enough shit to go to hell, right? And that makes it very stressful on your deathbed, doesn't it? Knowing what a prick you are, going, oh, this isn't going to be good. Hey? I don't want to go to heaven. I don't even want the option of heaven. I don't want to exist in a conscious state for the rest of eternity constantly thinking. I don't like thinking as it is. Where's me passport? Can't punch women in the face. The Bible calls heaven eternal bliss. I don't care how blissful it is. It's eternal. You'll get used to it, and then you'll be fucking bored. And what's hell meant to be like? Fire and brimstone and eternal agony? That's what's written in the Bible. That's God's book. As far as I know, the devil hasn't brought out a book. We don't know his side of the argument, right? If you ask me, the devil and God are having an argument. The devil's being a bigger fucking man. Because God's just writing shit about him. And the devil's going, I'm not even going to fucking comment, son, if you talk about me like that.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions.
You're listening to The Bill Ferguson Show.
Well, I've gone and done it. I've gone down the rabbit hole of Bitcoin again. So I have some updates, some information, not necessarily intended to say that Bitcoin is bad, which it is, or good. I'm just going to go over some facts and information that I've come across recently. You know, it's one of those things. I see an email. It started with a thing from Schwab where they were explaining what Bitcoin is. It was cute. It was really cute. They tried. I appreciate that. But then they had this one statistic that I was like, what? How do they know that? And it was something about 27% of all Bitcoins appear to be held by 0.01% of wallets or addresses, secret addresses. So 27% of the entire market, entire volume of Bitcoin is owned by not 1%, not 0.1%, but 0.01%, which if you had the vision of Bitcoin democratizing the world and making everyone equal, it just didn't fucking happen. I'm sorry, it didn't happen. And why do only a handful of people own so much of it? I don't know. Who are the people that own so much of it? I don't know. But average Bitcoin investor also doesn't know, which should concern you if one of your goals was to spread the money around the entire world so everybody has a chance. That is clearly not fucking happening. So the vast majority of people, a vast majority of Bitcoins are owned by a vanishingly small percentage of people that have accounts that trade, exchange, utilize whatever words we want to use Bitcoin. And I was like, well, that's nice to see that number, I guess, but where's that coming from? So I found out that it came from the National Bureau of Economic Research. This is part of the MIT Sloan School of Management. So this is information that a couple of researchers have gathered. You can Google this, of course. You want the NBER, or the National Bureau of Economic Research. And this is, what do they call it? Blockchain Analysis of the Bitcoin Market, working paper number 29396. And so I've skimmed this whole thing and found it interesting. And then now I'm going back and reading it in detail And I'm going to pull out a few things that I highlighted that I thought were interesting. One of them, of course, here in the introduction. And by the way, this is 55 pages with dozens. I don't think they have 100, dozens and dozens of footnotes, graphs, charts. So if you're into that kind of thing, it's pretty cool. It also has some wickedly complex mathematical calculations and formulas that are well beyond my capacity to understand. But there are a lot of things that I do understand, and I'll share some of them with you. One of the sections here, of course, the introduction, and I'm going to read this directly from the paper. Quote, Bitcoin, the original cryptocurrency, is still the largest and most popular coin with a market cap that is bigger than all other coins combined. In a way that's kind of weirdly reassuring for me, because I focus on occasionally talking about Bitcoin, and this wasn't planned at all. This was spontaneous from the link that I was given on the little white paper, little discussion from Schwab. But it's a great defense for me to have when people say, why don't you look at all 18,000 cryptocurrencies are out there? The reason I don't is because 17,999 of them don't equal the value of one, i.e. Bitcoin. So why would I chase around these little fragments when I can look at the biggest dog and try to learn something from that? So that's kind of where I'm going to stick with. And I don't really want to become an expert in other cryptocurrencies. It's like me becoming an expert in multiple religions and not just Christianity. I don't think a different religion is any better than Christianity. I don't think any Bitcoin or any cryptocurrency is better than Bitcoin. So why not to stick to the one I know? Someone else can do the other work. I guess it's not all up to me. And here's another interesting tidbit on volume, on the number of trades and transactions. Here again, quote, we first document that 90% of transactional volume on the Bitcoin blockchain is not tied to economically meaningful activity, but is the byproduct of the Bitcoin protocol design, as well as preferences of many participants for anonymity. Wow, I'll say that 10 times fast. Anonymity. Good thing it's not an Italian word. I wouldn't be able to say that at all. So here the gist is that people that use Bitcoin to actually buy something, and even that's in doubt, but that's 10% or less. They were able to document pretty easily through some clever techniques and algorithms that they designed. They're able to document that 90% or more of the transactional activity, the transactional volume, is not for economically meaningful activities, which I think also includes illegal drugs. So 90% of this. So what is that 90%? That 90% falls into a couple categories, and we're going to get to that in a minute. But it's basically, for whatever reasons, people that have a lot of Bitcoins are moving around a lot of Bitcoins. They're not doing anything with it as far as economic activity. They're just moving Bitcoins around. So I jump to another quote here. Different from traditional regulated exchanges, cryptocurrency markets consist of many non-integrated and independent exchanges without any provisions to ensure that investors receive the best price when executing trades. As a result, the consistency of Bitcoin prices across exchanges depends on arbitrageurs and speculators who trade across them. I have many times on this show talked about trading stocks and how there is a spread. There's a small difference between the price you pay and the price that you get paid, or the price that you pay, versus what the other party gets. There's often a little bit of slop in between that helps cover the smooth functioning of the marketplace. That exists here too, because the currency exchanges don't want to do all this work and have incredibly complicated and secured computer networks without collecting a fee. So there's a fee, there's a slop, and this doesn't give the exact dollar amount, but I'm betting it's not pennies per share like it is on stock markets on most occasions. This is probably going to be dollars per share. I don't know. But again, there is an inherent risk in not getting the best execution. So if you own some Bitcoins, how do you know you get the best price for them? Given the volatility and the possibility of not getting best trades, you could lose a generous chunk, when you're buying, and you could lose a generous chunk when you're selling. I don't know what that generous amount is, 1%, 12%. I don't think it's going to be 1 or 2%, but so that's something that is a deterrent for me. I'm less likely to want to do something if there's a chance of me losing money on buying and selling. It's one of the reasons I don't do something like gold or coins. Because if you go to a local coin dealer, you're not getting what the price they paid to put the coins into inventory. They're selling it for some significantly, or at least materially, higher price because they want to make a profit. And then at some point you decide to liquidate your gold coins, and you go to a little gold shop, a place that would buy these from you. They're going to buy them for an amount that's significantly less than what they're actually worth because they want to sell them for what they're worth or more. So you can have a lot of, economic friction. I don't know what else to call it. Costs and transaction costs, I guess, in doing that. It can be very steep. The next section they go on to is know your customer. I've actually recently talked about this, and who knows, maybe this is why this has popped up. The know your customer rules apply, especially in the United States, but many countries around the world, for brokerage firms. The brokerage firms are required to collect your date of birth, your name, your social security number. If you want to open up an IRA, a Roth IRA, a 401k, any type of account that you are used to in the United States, or almost any type of an account you want to set up anywhere else in the modern world, they are going to collect a lot of information about you. And they have to, because those are the laws and those are the rules. And it helps keep everything above board. But for some people, it's just too damn scary, and they don't want the government having that information. I get it. I can appreciate that. But, everything has trade-offs. And so one of the problems with any organization that doesn't have this know your customer information, it's really hard to know who is buying and who is selling. For a lot of people in Bitcoin, that's what they want. Now, the interesting thing that because the ledger is distributed, highly distributed, and anyone who plays the game to mine Bitcoins has a copy of the entire ledger, which I think is another problem with the whole system. But everyone can see where the money went and who got it and who moved it. Now, they can't see exactly who you are. They don't know your name and social security number, but they know the address of your wallet. So a lot of organizations, when they move Bitcoins around, make the Bitcoins move through layers, dozens and sometimes hundreds of layers, through different exchanges, through different countries, through different IP addresses, all with the intent of making it harder and harder and harder for government agencies to find you. If you're just an individual schmo trading a few Bitcoins, don't kid yourself. They know who you are. They know where you live. And there is an increased push, and I think eventually it will become law. And I've said many, many years ago when I first mentioned Bitcoin that you will be able to escape government scrutiny until the government thinks that it's missing out on something. If Bitcoin ever comes to the point where it threatens the dollar, it will be put down like a lame horse. It won't survive it because we, the people, or the government of the people, want some, if not all of these controls. I mean, many of them we individually don't want, but we don't want people just pushing money around without having any idea of who's got it. And of course, we learned from earlier in this segment that the vast majority of Bitcoin is controlled by a vanishingly small percentage of the people that own Bitcoins. So if you're buying more Bitcoins and increasing the demand for the supply, who are you helping to make money? Maybe you, if someone comes along and buys from a higher price than you bought. But who are the whales? That's the word that they use in the crypto world. The whales own huge chunks of Bitcoin and other cryptocurrencies. Who are they? They want to be secret. They desire to be secret, and they want to sell you on the idea that it's great for them to be secret so you can never come look for them when they take all the money. One of the really neat things that the authors of this paper did was they were trying to look at the transactions by IP address. And of course, the IP addresses, you can get a VPN, you can get an IP address from anywhere in the world. Cool. But another thing that they found which was really neat, not related to IP addresses, but they found a series of traders, a series of owners, and they were able to identify their location based on electricity usage. So it doesn't matter what IP address you're showing in the world, you're getting electricity nearby. That's something that can tie you, at least you generally, into a location on the planet. And back in April of 2021, a large part of China lost all electrical supply. And so they were able to document all of the miners, all of the owners that suddenly stopped trading, suddenly stopped mining. They weren't mining Bitcoin. They weren't buying anything with Bitcoin. They weren't moving around Bitcoin. And some of them lost or performed suddenly 30, 40, 50%. A couple of them were either 90 and 100% loss of volume. And then when the electric power came back online a couple of days later, it's kind of like being in Texas. Yeah, China, Texas, power supplies. So they were able to document where these participants in the blockchain, in Bitcoin, were probably located by looking at the map and what areas lost 100% of their electricity. That and other things that they've looked at have resulted in basically the idea that not necessarily mining within China, but IP addresses that mine and or control Bitcoin, the prices and the movement of Bitcoins back and forth, a large percentage of it, probably close to half of the world, has some kind of influence in China. If that's the case, again, if you are somebody helping to drive up and promote Bitcoins so that you can make money, you might be actually helping the Chinese government make more money. Well done, Bitcoin miners. There was another section where they talk about new accounts, and one of the things that people are doing that are moving Bitcoin around a lot for whatever reasons, to maintain secrecy, to keep hiding themselves. They are moving Bitcoins into and out of accounts that have existed for hours. And so they found out because apparently in the blockchain data, you can see when a new account first comes on board, first does a transaction. I mean, that's inherently obvious, I think, from how the blockchain works. You can see every account that sent or received money. So the first time an account opens or receives or sends money, well, that's probably when it became active, probably when it was created, because someone didn't create, I guess, accounts 10 years ago and just hang on to it. So a lot of these accounts pop up in the tens of thousands, move cryptocurrency around, and they don't necessarily close, but they're never used again. And you can easily see that in the blockchain data. So again, those are people who are not engaging in any kind of commerce. They're doing something else. What is that something else? One of the things that they mention in the paper, that Bitcoin is very useful at money laundering. So you move money 4 or 5 or 6 or 7 different times through exchanges that don't follow the know your customer rules. And that's one of the reasons they're there. And the money ends up in someone's hands. You have no idea where that money came from, how it got there, was their activity legal or illegal. And if we live in a society that wants to discourage illegal activity, this is something that makes it easier for people to engage in illegal activity and then be able to actually spend the money that they made from these illegal activities. Now I have, it's a paragraph, but it's a short paragraph, so I'm going to read this from this document that talks about this very thing. Quote, consider, for example, a situation where a hacker demands payment from a company to be sent to a Bitcoin address he controls. Since the ransom address is public information, if the market hacker later sends Bitcoins from this address to a third party, the third party could easily flag the funds as coming from illegal activity. To prevent this from happening, hackers often try to obfuscate. I don't know that I've ever read that word aloud. You know what I'm saying? Obfuscate. Wow. Tracing by creating multiple addresses and splitting the initial payments among them. This process is usually repeated many, many times, resulting in so-called peeling chains, where funds travel a long distance from one address to another, leading to a large amount of fictitious volume on the ledger. And so this again plays back into the idea that a lot of the transactions are just people moving money around. It's not economic activity. It's not causing a benefit to the economy in any way or used as a currency. It's used as a way to hide money that you don't want people to see, because the ledger is not anywhere near as private as you think it is. If it was totally, totally private, they wouldn't do any of this stuff, but they do because it's all visible. At least the accounts are, and you can dig in and find other information to link people to specific accounts. And I think just for brevity, the last section I'm going to cover is about the mining. I'm not going to go into the specific details of how it works in this segment, but also from this paper, top 50% of miners control almost all mining capacity. The top 10% control 90%, and just 0.1% control close to 50% of the mining capacity. The reason that is so meaningful is that Bitcoin, like any other cryptocurrency, I think, and I don't know, I'm not an expert on all of them, nor can I be, nor will I be. But for Bitcoin, it's a bit of code, it's a protocol, it's a process, and it has very defined rules and regulations on how it works. But it can be changed by a vote. It can be changed in almost any way if 51% of the people involved, and that is defined by hash power, your ability, your process, your computational power to process and solve the mathematical riddles that allow you to certify or a specific block and confirm that that's what happened with the transactions within that one given block. And then, of course, you're rewarded coins for that. If a majority of the hash power, if the majority of the miners, I'll just do it that way, get together and someone makes a resolution or suggests a change, if most people don't like it, they say no, they vote it down. But if 51% of the miners like this new idea, they can vote yes, and poof, like that, the rules and the protocols for what is Bitcoin and how it works change. And this is a long known thing called a 51% attack. And right now, 50%, according to this paper, is controlled by just 0.1% of the miners. So not 1%, but 0.1%. So 1/10 of all of the miners, because of the power necessary, the economic scale that is now required. This is not generally something you can do successfully on your home computer anymore. And it will get more expensive to mine the coins. And if the price goes up, it's more rewarding to mine the coins. But you have to have a big setup. You have to have a lot of power. You have to have access to power that's uninterrupted, uninterruptible power. You have to have the knowledge and the expertise to build a mining kit, a mining factory, entire buildings with air conditioning so that the equipment doesn't overheat. It now takes, experts and large size to get most of the mining. Sure, you could have your computer do it in the background, but you're now so small compared to these giant companies and organizations that you're probably never going to benefit. So you're just burning through the processing power and electricity that you're using at home to probably not get anything out of it, or at least not get enough to cover the energy and the time and the effort that you wasted. So it has to be done at scale. It has to be done at large size. And so if 1/10 of 1% of the miners decide to make some rule change, the rule changes. So is that what you wanted? Is that what you signed up for? Is that the vision that you had when you started down the road of buying Bitcoins? I'm going to wrap up. I haven't even gotten through half of the text of this section. And of course, there's beautiful charts and graphs at the end, which you can read. If you're really curious about how Bitcoin works from a non-marketing standpoint, if you if you go on YouTube, someone's going to tell you it's awesome and great for them. But if you want to kind of get into it and understand it, this is not an easy read, by the way. This is quite a long read, but fascinating. But I don't want to make this segment too long. So I'm going to wrap up. That's just kind of some information about Bitcoin. And let me jump back up to the top here in case you didn't get it earlier. National Bureau of Economic Research, MIT, Cambridge. And this is called Blockchain Analysis of the Bitcoin Market. And it's working paper number 29396. So hopefully you can find it and download it. It's just downloads as a PDF, 55 pages. And good luck with reading that. If you think I got anything wrong in this, let me know. I know some things, but I'm not like a total expert on it. And I'm relying on some of the information on this paper. But I think it was mostly accurate and hopefully useful and help you to understand maybe a little bit more behind the scenes of how Bitcoin works.
Do you mind spending 30 seconds on dark matter just for the heck of it? So when we observe galaxies, we find that they're spinning around at such a rate that stars on the edge should be flung outwards, sort of like water droplets on a bicycle wheel that's spinning fast, the water gets flung out. Yeah. But the stars aren't getting flung out. Something must be holding them in. We don't see anything that can do that, but we know gravity has the power to hold things together. So we imagine that maybe there's some matter out there that we don't see, dark matter. That's why we don't see it. It doesn't give off light. And that matter is exerting a gravitational pull, holding those stars together in these spinning galaxies. And when we make that hypothesis, it explains observation so spectacularly well that we begin to gain confidence that maybe the stuff that we haven't yet seen and we haven't yet touched or smelled yet, maybe it's real. So we build big detectors and we try to capture one of these dark matter particles. We haven't succeeded yet, but I think that we will. So this is a beautiful example of how observations drive rational thinking to explain the facts and ultimately verify it through observation and experiment that can be replicated. That is what science is.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions.
You're listening to The Bill Ferguson Show.
Can we talk? I mean, just for a minute. Just you and me. We're going to talk about eyeglasses. The last time I went to an eye doctor, I found out, was about 6 years ago. I went to, I think it was a Walmart or something like that, and had my eyes examined, and then started looking at lenses and frames, and it blew my fucking mind how much it cost. They wanted to give me a pair of frames. Eyeglass frames. I guess they're a pair. Like pants are a pair, but they're not. It's just one pair. Anyway, the frame plus the lenses plus some upgrades. One example, if you have a really strong prescription, which I do, there's an index factor of how thick the material needs to be to bend the light enough to compensate for my fucked up eyeballs. And so if your vision is really bad, and particularly if you get big glasses, the edges of them become super thick, the old Coke bottle thing. But I don't want that super thick look. I want thin glasses, so I get smaller lenses and I get higher index lenses, which are more expensive. There's coatings to prevent scratches. Well, I guess limit scratches. There's coatings to tint the glasses. There's coatings to prevent them from misting up, anti-fog coatings, all kinds of coatings that you can add to a lens. And so in this case, inside the Walmart, it ended up being something close to $500 for a pair of glasses. I don't specifically know how much it costs to make a pair of plastic or metal or aluminum or titanium glasses, but I'm thinking $500 to $600 is too much. I don't know. I mean, but I'm just looking around at other things. I could buy a new desktop computer. And what a wickedly complicated machine and so many parts and things. For the same money, I buy a pair of eyeglasses. That didn't seem right to me. So 6 years ago, I walked out of that Walmart with my prescription in hand, And I went online and I found a website. There's multiple ones that you can use. I'm not promoting this specific one for any other reason other than that's what I found. Boy, it'd be nice. No, I guess I couldn't have them pay me because all those conflicts things. But anyway, I use Zenni, Zenni, and I ordered some glasses. And the glasses cost about $150. I bought a second pair that were a little more simple, not as many coatings, as a backup pair for like $85. And it's in my travel bag. So what I don't want to have happen is I'm away from home and my glasses, I lose them, I drop them, I break them, they shatter, whatever. So at least I had something to fall back on until I could get home or order a new pair. I even went to one of those places where they do same day glasses or next day glasses. And because of the strength of my prescription, they're like, no, we don't have that stuff here. So we have to order them anyway. It's going to be a month for you to get them. And it's still $500 to $600. So I went to Zenni and like I said, $120, $150, whatever it was. So now we jump forward 6 years in time and here we are, poof. And I went to the local eye doctor and like any business, for an additional fee, which I thought was worth it as far as the observation, they took photographs of my retina, did other examinations. I was there for over an hour meeting with the person doing the data collecting and with the doctor. It seemed fantastic. And the thing that drove me in is the fact that I think I've talked about this on the show. I have dry eyes and it freaking, oh my God, what a pain in the ass. And sometimes I get different drops and they work, but then they don't work. And it's a real big problem. And it's probably dramatically exacerbated by the fact that I sit at a desk and look at computers for way too long. Well, this eye doctor explained it to me. So side note, how dry eyes work, at least in my situation, there's little ducts in your upper and lower eyelids that pump out tears, moisture, that keep your eyes lubricated. Well, there's a second set of ducts that do the same thing, but they don't pump out tears or water. They pump out oil or fats, probably is what it's going to be. And the funny thing is it might actually be worse because I'm taking a statin medicine to lower my overall cholesterol. Isn't that funny? Side effects of drugs. But so the oils aren't being produced at the level they should be, even if your eyes are producing the tears or the water at the level that it should be. The water spreads across your eye when you blink, but when you open your eyes, any breeze or air moving by evaporates the moisture, the water, and poof, your eye is dry. So you can produce a sufficient amount of tears, but still have dry eyes because the oil isn't there. So we're working on that, and maybe I'll do a segment on that if you're curious. But anyway, back to eyeglasses. So I get done with the examination, and like everything with me nowadays, I feel like that fucking old guy. When I was a kid and I'd go to buy a 25-cent candy bar, and there'd always be somebody going, 25 cents? Kid, I remember when I was your age, it was a nickel. Yeah, I get it. I get it, old man. Oh, fuck, that's me now. I look at a candy bar and I think it should be 25 to 50 cents, and it's $1.79 or $2.49 at the gas station. Well, that's an inducement for me to not buy a fucking candy bar that I don't fucking need to eat. Anyway, aside from that, so the total visit was like $200. Again, I think the last time I paid was under $100, but it was 6 years ago. And it didn't have the cool photographic equipment to take images of the backs of my eyes and all that extra stuff. And of course, they have the machine that blows air into your eye, which sucks. But this one was much better to test for all this stuff. And it's probably something I know it's recommended for me, particularly to go once every year because I'm pre-diabetic. That runs in the family. Yay, me. And so there's certain illnesses and diseases that you can get in your eyes that are much higher probability if you're diabetic. So I got to keep an eye on that. Well, anyway, when I get done and I look at a few of the frames that they have, and they have, Chanel and Gucci, whatever names. The first pair I picked up from what was obviously the cheap section in hindsight, because it looked like a bookshelf. Those were $300 and up. And I went over to the brand names like the Gucci and all these other things. And the prices for the frames, we haven't even talked about the lenses yet. For the frames, just shy of $1,000 for a designer frame. A designer frame. And I'm thinking to myself, if it costs $1,000 to buy a designer frame, I could get a plane to fucking Italy and go in a store there and probably buy a frame and fly back and have money left over. I don't know. I'm going to check next time I'm in Italy, if I'm ever allowed in Italy. COVID, Putin, thank you. If I ever get back to Italy, I'm going to check their prices there. But so $300 to almost $1,000 for the frames. And then we didn't even get into the lenses because the lady comes down, very nice, obviously sales focused and probably gets a commission. So I hear you're getting new glasses today. And I said, no, I'm not. What? I'm not getting new glasses today. But your glasses are 6 years old. The doctor changed your prescription. You need new glasses. I do need new glasses. I'm not buying them here. I'm not buying them today. Thank you very much. And I was actually kind of surprised she let me go that easily. But anyway, I went back to Zenni. That's how I know my last pair of glasses were from 6 years ago, because they still have my order. To be painfully easy, I just said, I want the same fucking glasses because I know they fit and I know they worked really well. And so the frame, the metal frame, the temple pieces, one over the left ear, one over the right ear, the frame that the lenses sit in, the cost for the frame was $695. No, not $695, $6.95. Yes, that's right. The new frames were $6.95. When I went to look at the lenses, of course, there's different kinds, and we talked about briefly the indexing. So I want them to be as powerful of a material and as thin as a material, as light as possible. So I paid for the better lenses. I paid for 3 or 4 different coatings, and then I paid almost $20 for them to ship it faster. And by faster, it means a week or a week and a half. So hopefully by the next show, I'll have them on and I can tell you how wonderful or not they might be. And all of this combined, out of pocket, $150. So for the frames, for the lenses, for all the magic coatings. Oh, and they're gonna send me a little free laser. That's cool. I can use that with the cat. But the glasses, everything out the door was $150. My prescription did change. Ironically, my eyes are better, according to the eye doctor. That happens with old people sometimes. There's a short period of time where your eyes actually get better. Whatever. Yay, me. But yeah, so glasses that were going to cost me probably $600 to $800 to $900. I wasn't going to buy those frames. Okay, glasses that were going to cost me $500 to $600 cost me $150. That's with extra bells and whistles and expedited shipping. I could go on and buy another pair, and maybe something I'm not going to read as often, or something maybe for the office where I don't need the progressive lenses. By the way, these aren't even single vision. They're not bifocals. They're progressives, which are more expensive. So all of that, if I cut down a few of those perks and bells and whistles, I could buy a pair and have them ship them to me slow for under $100 total. $90 maybe. I'll check and see. Now, like I said, I took the easy way out and I ordered the exact same fucking frame I got 6 years ago because I'm boring and lame like that. It's how I look. It's easy. I knew they would fit. All you need from your doctor is a piece of paper. Hang on a second here. Sound effect. Paper. It sounds like this. It's paper. And it has half a dozen numbers on there. One thing that you will need is what's called the PD number. That's the pupil distance number. And they will have that. They'll give that to you. The only thing that they might not give to you, they probably will not give to you, that you might need for helping to pick the glasses you want to know the size of the bridge of your nose. And so what you can do is look at your camera with a little ruler on your face, and you can figure out the approximate width of the bridge of your nose. It's not going to vary a whole lot, but for some people it's bigger or smaller. And you want to measure basically where you normally expect your glasses to sit. And then the other thing you want is the total width of your face. So where the what do they call these? The legs? No, the parts that go over your ear, the temple pieces. You want to know how far apart the temple pieces are. You want to know basically the width of your head. So if you've got a ginormously oversized fat head like me, you want to know that. And then maybe the length of the temples, just as a general idea. But for most people, most of the stuff is within a few millimeters of each other. And even when you're trying lenses on in the store, they're all about the same size. But you can tweak these little numbers, and on Zenni, and I'm sure these other places have it too, you put in all that information for your prescription, the size and the shape that you want, and then you just go fucking hog wild. Any kind of metal, any kind of plastic, any color, any shape, any size, thousands upon thousands of frames to fit in. And if you've already entered your prescription, it might say, given the prescription for the lenses that you need, these glasses aren't suitable. Cool. You filter all those fuckers out and you can go crazy. And of course, Zenni has a tool like many others where you can take a picture of your face using your webcam and it will show the glasses on your face. It's a neat little tool. And anyway, so that's how my cost of eyeglasses went from like $600 to just a little bit over $100. Almost forgot. One last thing you could look for on YouTube just for fun is Adam Ruins Everything, Season 1, Episode 22. You can find it easily on YouTube. It's also The Conspiracy Behind Your Glasses / Adam Ruins Everything. So just eyeglasses, Adam Ruins Everything. And they go over in that video a lot of the same stuff that I was just talking about. So again, hopefully that helps, and we'll go on with another part of the show. Isn't it absolutely amazing the scam or the scandal of what you have to pay for eyeglasses nowadays? And it's one of those things that, if I had to pay $700 for the glasses instead of the $150 I spent, and I do expect them to arrive any day now, if I had to spend the $700, I can do it. But holy fuck. I mean, there's a lot of people who are getting by and they show up to the eye doctor and they have to, of course, pay for the examination, which can be a lot of money. And they're not told about their choices. They're not informed about their options. And I'm guessing it's not the business's responsibility to tell you that you can buy something at 20% of the value somewhere else, 20% of the price somewhere else. But the idea that they're okay with hitting you up for $700 or $800 or $900 for a pair of glasses, they have to know full well that you could get it for $150 somewhere else. I mean, they know that, but you don't know that. Like I said, it's not their job as a business, but I don't know. Sometimes it's one of the current themes that I'm keep thinking about a lot is, why does everything have to be a trick? Why does everything have to be challenging and complicated? And why are so many business models designed to see how much they can fuck you? Why can't they sell glasses and make a 20 or 30% margin and be really happy with that and make a lot of money? But instead, like in my case, instead of buying a $300 to $800 frame, the frame I ordered was $6.95. I shit you not, $6.95. So I'd love to hear emails from anybody that said, holy shit, Phil, you've changed my life. I can get new glasses. I can go buy 2 pair of glasses and still pay a third, probably, of what I would for the 1 pair. So if that's worked out for you, if you got any great ideas, or you like one glass provider over the internet versus another, let me know. Of course, my email is phil@polarisfinancialplanning.com. So a couple of things coming up. I've been probably averaging a show once every 10 days. Ideally, I would like to do it weekly, but I got a lot of things going on. I do have the trip to Atlanta, where I will be at the American Atheist Convention. And of course, I'm expect to have a great time, and I hope to see you there. And I hope that you come up and say hi to me. And it's been 2 years, my friends, 2.5 years maybe even closer to 3 years, since I've seen almost any of you. So if you come up to me and you're so excited to see me, and I would love that you would be, and I forget your name, or I can't connect your name to your face, but I recognize your face, please forgive me. That's not my greatest strength. I do better with numbers. Used to be really good with names when I was like 18 and 20. But I'm not 18 and 20, so if I don't come up with your name right away, just shout it out. Let's get over that. Forgive me in advance if I don't recall your name. And then let's sit down. Let's chat. I'm going to have a table, I think. I have a table. So for most of the conference, I won't be inside sitting quietly in a dark room listening to a lecture. I love doing that, but I often have a very hard time staying awake with that. And I would much rather visit with so many of my long-term friends. And the American Atheist Conference, like I said, the last one was not 1, but 2, but 3 years ago. Holy shit. 3 years ago. The American Atheist Conference is probably the one conference where I know the absolute most people that show up at one time. And I'm so excited to see you. So please, but keep in mind, I'm going a little early. I might stay a little late just to make it chill and relaxing. I'm not going to be in a rush to get in and out. So I'll be away from the office for a few days over Easter. Hopefully you're enjoying family or fun or going to the conference yourself, and no one or very few people want me to do a lot of work. So maybe I get a few days where I'm not working, but I also won't be making the show. And I've got a couple other trips that I might take that aren't secular related, and I don't want to go into too many details yet. I'm optimistic everything will work out. But the shows might have even a bigger gap. There could be a couple of weeks. I don't think a whole month, but there could be a couple of weeks in a row where there's not a show. Everything's fine. I'm just doing some other things, which yay for me. And I can give you all the details when I get back if those trips actually go off as planned. So if you like the show, you can always recommend it to friends and have more listeners. I just checked on Patreon, by the way. There's still 26 patrons. They're not paying me anything because I'm not collecting any fees there anymore. And I'm not even putting up shows. So hopefully at some point they've figured out that there's other ways to find the podcast, and they have found those other ways. So thank you again for anyone that had supported in the past. It's just one of those things I'm trying to clean up, eliminate, reduce any even theoretical possibilities of conflict of interest. So that's just one of the things that I decided to get rid of. So I'm no longer taking contributions or even really normally checking. I see there's a note right here on Patreon, so I'll go check it after I get done recording this. But if you're still a patron of the Phil Ferguson Show, go turn that off. Go give some money to somebody else. I appreciate it. I do very much. I appreciate it. Go help somebody else that probably needs the couple of bucks more than I do. I guess that's it. I don't even know what other conferences are this year. So if you have a conference, you're running a conference, you're organizing a conference, you'd like to come talk about it, let me know. Maybe we can find a time for you to chat and give a web page and tell us about how cool your conference is going to be. But the one that's coming up is the American Atheists in Atlanta for Easter weekend. And I do hope that you go. And if you do, please say hello. I'd be happy to see you again. Until then, ciao.
Who's there? It's the kids in magic underwear. Latter-day pimps, motherfucker. Let me tell you a story about my man Joe Smith. He's the founder of our posse that you just can't fuck with. Wrote a little book called The Bible Part 2. Book of Mormon, bitch, preached by me and my crew. Mormon for JJ, that's my kryptonite. Spread the word all day, spreading pussy all night. CT all blinged out, ring so sick. Choose the right, got it tatted on my dick. Rolling R5 flex in your neighborhood. Spit religion, jock and bitches, yo, we're up to no good. Knock, knock.
Who's there?
It's the kids in magic underwear. Knock, knock.
Who's there?
It's the kids in magic underwear. Knock, knock.
Welcome, brother.
It's the kids in magic underwear. Knock, knock.
Good afternoon.
It's the kids in magic motherfucking underwear. Break these motherfuckers off, Elder Gooch.
Okay, I'm gonna try my best.
Christ rules everything around me. Cream, get the money. Tithing to the church, y'all.
Call me Elder Nasty, cause it's written on my bag. Gotta wait for my wedding night to penetrate the bag. I'm a virgin like a daiquiri. I'll charm you with my flattery. I'll give you my last name, and you'll be my baby factory. Wife 1, wife 2, wife 3, wife 4. My ass is on a mission to wed a couple more. Streets of Utah's where I got my education. Hardest missionary in the LDS nation. Scripture on my hip like a load of Mac 10. Peeling caps back with the fiction within. We're the leaders of the pack, and you know that for a fact. Gonna run America, cause Romney's got my back. Knock, knock.
Who's there?
It's the kids in magic underwear. Knock, knock.
Who's there?
It's the kids in magic underwear. Knock, knock.
Who is it?
It's the kids in magic underwear. Knock, knock.
Oh, for Pete's sake.
It's the kids in magic motherfucking underwear.
Big ups to the Angel Moroni.
I can't wait to get our own planet. Let's go spread the word.
I'll get our bike helmets.
Peace, we're out of here.